Imagine owning a tiny piece of your favorite company, like Apple or Amazon. This is not just a fantasy, it's a reality made possible by the stock market. The stock market is a fascinating and dynamic place where everyday people can become part owners of some of the world's most successful companies. That's what the stock market allows you to do. It provides a platform where shares of publicly traded companies are bought and sold. This marketplace is essential for the functioning of modern economies. It's a bustling marketplace where you can buy and sell shares of publicly traded companies. The energy on the trading floor is palpable, with traders making split-second decisions that can impact the financial world. These shares represent ownership in the company. When you hold a share, you own a small piece of that company, giving you a stake in its success. When you buy a share of stock, you're essentially becoming a part owner, albeit a very small one, of that company. This ownership can come with certain rights, such as voting on important company decisions. The stock market operates like an auction. Buyers and sellers come together to negotiate prices, and the highest bid usually wins. Prices for stocks fluctuate throughout the day based on supply and demand. This means that the value of your shares can go up or down in response to market conditions. If more people want to buy a stock than sell it, the price goes up. This is often driven by positive news about the company or the overall market. Conversely, if more people want to sell a stock than buy it, the price goes down. Negative news or poor performance can lead to a decrease in stock prices. This constant dance of buying and selling is what makes the stock market both exciting and potentially profitable. It's a place where fortunes can be made or lost in the blink of an eye. As a shareholder, you have the potential to earn money as the company grows and its stock price increases. This growth can come from the company's expanding business, new product launches, or overall market trends. Investing in the stock market can be a rewarding experience, but it's important to understand the risks involved. There are two primary ways to make money in the stock market: capital appreciation and dividends. Capital appreciation occurs when the value of your stock increases over time. Let's say you buy a share of company XYZ for $50. If the company performs well, demand for its stock increases, and the price rises to $75. You can then sell your share for a $25 profit. Dividends, on the other hand, are like bonus payments made by some companies to their shareholders. When a company earns a profit, they may choose to distribute a portion of those earnings to shareholders in the form of dividends. These dividends are typically paid out quarterly and can provide a steady stream of income for investors. Not all companies pay dividends, but those that do tend to be more established and financially stable. Compound interest is a powerful force that can significantly grow your wealth over time. Unlike simple interest, which is calculated only on the principal amount, compound interest is calculated on the principal amount and also on the interest that has been added to it. It's the concept of earning interest not only on your initial investment but also on any accumulated interest. This means that your investment can grow at an accelerating rate. Think of it like a snowball rolling downhill, getting bigger and bigger as it gathers more snow. Here's a simplified example. Let's say you invest $1,000 in a stock that earns an average annual return of 7%. This 7% return is added to your initial investment, increasing your total balance. After the first year, your investment would grow to $1,070, $1,000 plus $70 in interest. This new balance becomes the principal for the next year. In the second year, you would earn interest on the new balance of $1,070, resulting in $1,144.90, $1,070 plus $74.90 in interest. This process continues year after year. As you can see, your money starts working for you, generating more and more interest each year. The beauty of compound interest is that it leverages time to grow your wealth exponentially. The longer you stay invested, the more powerful the compounding effect becomes. This is why starting early and being consistent with your investments. When you watch the financial news, you'll often hear about stock market indexes like the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite. These indexes are crucial indicators of the stock market's health and performance. They act like scoreboards that track the performance of a specific group of stocks, giving investors and analysts a snapshot of market trends and economic health. The Dow Jones Industrial Average, often referred to simply as the Dow, is the oldest and most widely followed stock market index. It was created by Charles Dow in 1896 and tracks the performance of 30 large, publicly owned companies such as Apple, Microsoft, and Coca-Cola. These companies are leaders in their respective industries and are considered blue-chip stocks, known for their stability and reliability. The S&P 500, or Standard & Poor's 500, is a broader index that tracks the performance of 500 large-cap U.S. companies. This index represents approximately 80% of the total U.S. stock market value, making it a more comprehensive indicator of the market's overall performance. The Nasdaq Composite, on the other hand, is heavily weighted towards technology companies. It includes over 3,000 stocks with a focus on companies in the technology, biotechnology, and internet sectors. This makes it a key indicator of the tech industry's health and innovation trends. By following these indexes, investors can get a general sense of how the overall stock market is performing. They provide valuable insights into market trends, helping investors make informed decisions about buying, holding, or selling stocks. Understanding these indexes is essential for anyone interested in the stock market, as they offer a window into the economic landscape and the performance of different sectors within the market. Section 5, Riding the Waves, Bull versus Bear Markets. Just like the ocean has tides, the stock market experiences cycles of ups and downs. These cycles are often referred to as bull and bear markets. A bull market is characterized by rising stock prices and a general sense of optimism among investors. During a bull market, investors are more likely to buy stocks, driving prices higher. Conversely, a bear market is characterized by falling stock prices and a general sense of pessimism. Investors tend to be more cautious during a bear market, selling stocks and moving their money into safer investments. It's important to remember that bull and bear markets are a natural part of the stock market cycle. They are influenced by a variety of factors, including economic conditions, interest rates, and investor sentiment. Section 6, Separating Fact from Fiction, Debunking Stock Market Myths. The stock market is often shrouded in myths and misconceptions that can deter people from investing. One common myth is that investing is just like gambling. Yes, there are risks involved in both, but investing is based on careful analysis and long-term growth potential. Gambling, on the other hand, relies solely on chance. Another myth is that you need to be wealthy to invest in the stock market. This simply isn't true. With the rise of online brokerage accounts and fractional shares, you can start investing with as little as a few dollars. Finally, many people believe that market crashes wipe out all your money. While market crashes can be scary, they are typically followed by periods of recovery. Section 7, Smart Moves for Steady Growth, Minimizing Risk in the Market. Investing in the stock market involves inherent risks, but there are strategies you can employ to minimize those risks and protect your investments. One of the most effective risk management techniques is diversification. Diversification means spreading your investments across different asset classes, such as stocks, bonds, and real estate. By diversifying your portfolio, you reduce the impact that any single investment can have on your overall returns. Another important strategy is to invest for the long term. The stock market is inherently volatile in the short term, but over the long term, it has consistently trended upwards. By adopting a long-term investment horizon, you can ride out market fluctuations and benefit from the power of compound interest. Section 8, Fascinating Figures, Fun Facts from Wall Street. Did you know that the first stock exchange was established in Amsterdam in 1602? Or that the largest one-day percentage drop in the Dow Jones Industrial Average occurred on October 19, 1987, known as Black Monday, when the index plummeted by over 22%? The stock market is full of fascinating facts and historical events. For example, the world's first publicly traded company was the Dutch East India Company, established in 1602. The stock market has also been the birthplace of numerous innovations, including the first ticker tape, which was used to transmit stock prices in the 1860s. Section 9, Your Journey to Financial Freedom. Invest wisely, live richly. The stock market can be a powerful tool for building wealth and achieving your financial goals. By understanding the basics of how the stock market works, you can make informed investment decisions and potentially reap significant rewards over time. Remember to start small, diversify your investments, and stay focused on the long term. Investing in the stock market is a journey, not a get-rich-quick scheme. With patience, discipline, and a commitment to continuous learning, you can navigate the ups and downs of the market and create a brighter financial future for yourself.